In the decade of the 70s, according to the US government, through inflation, we reduced the purchasing power of the US dollar by 75% over 10 years. Not coincidentally, the gold price went from $35 to $850. The only way that we can service the nominal debt that we have as a people, particularly our entitlements obligation, is to inflate away the net present value of the obligation while leaving the nominal value intact. An old geezer named Rick Rule, 71 years old. I don't know what Social Security pays me, but let's say it's $4,000. I was a high income taxpayer. 10 years from now, they'll still pay me that nominal amount. They won't reduce it, although they can't afford to pay it. What they will do is they will inflate away the net present value of that nominal account. So my $4,000 will buy me $600 or $700, maybe $1,000 worth of goods and services. That's how you deal with that sort of thing. You either default honestly. The audience that got an erection about an increase in the silver price over $32 to give their head a shake. When you go into a silver bull market, you won't be concerned about dollar moves or dollar and a half, and you won't need some old crank named Rick Rule to tell you when you have a silver market. By the way, it's when. The market will be absolutely positively dramatic. And if you aren't prepared for it, maybe early, maybe 2 years, the best part of the move, you'll lose. When I look back to my recent silver junior trade, I had no idea where the silver price was going to go. I just knew that you had a sector that was extraordinarily volatile, that had no sellers left. Market. All of the social media discussion was despondent about the silver market. High quality silver issuers, juniors, weren't getting funded, which is to say the momentum was terrible. Well, of course the price is going to go up. If all the sellers have been exhausted, it doesn't take much of a buyer to drive the price. Now, 9 months later, the prices are up 300%. Guys go tell the same story at Beaver Creek that they told last year, and as opposed to taking 7, they're offered 60. What does that tell you, Kai? Yeah, I mean, the US dollar is the worst currency in the world, as Doug Casey would say, except all the others. Doug described the US dollar as an IOU nothing. He described the euro, which has 15, 16 countries? As a who owes you nothing. And I would suggest that the BRICS, a bunch of countries with inconvertible currencies who don't like or trust each other, is a nobody owes you anything. So in that league, the US dollar is pretty strong. I save and insure in gold. I maintain my liquidity in US dollars, and I invest in companies. That's sort of how I look at it. I have a lot of US dollars right now because I have more liquidity than I would like to have, which is really a consequence of the fact that I'm like Buffett, is unsustainable.
Gold and silver hold a timeless allure, their value transcending eras of economic turbulence and market skepticism. Rick Rule's insights highlight not just the monetary, but also the psychological significance of these metals, particularly in a world beset by fiscal mismanagement and looming debt crises. As the global financial system teeters, the role of precious metals as safe haven assets becomes more pronounced. Over the years, gold has consistently proven its resilience. Since the turn of the millennium, its price has soared from $253 an ounce to over $2,600, marking a remarkable 7-fold return. Yet many investors remain impatient, questioning, when will gold move? The reality is that gold has been moving steadily and reliably for decades. It's not a sprint, it's a marathon. This historical perspective is crucial. During the 1970s, a decade marred by inflation and economic uncertainty, gold skyrocketed from $35 to $850 an ounce. That's a 2,300% increase, achieved amidst an environment where the purchasing power of the US dollar was eroded by 75%. This wasn't just a market rally, it was a redefinition of value in a collapsing monetary system. Fast forward to today, and we see similar conditions brewing. Central banks are cornered, unable to raise taxes significantly or cut entitlements without political fallout. Instead, they resort to the age-old strategy of inflating away debt. The result? A weakening dollar and a strengthening case for gold and silver. Rick Rule's pragmatic approach to wealth preservation revolves around 3 pillars: savings in gold, liquidity in US dollars, and investments in companies. While he acknowledges the relative strength of the dollar compared to other currencies, he is quick to remind us that its stability is an illusion. The dollar, like all fiat currencies, is an IOU nothing. Its value depends on trust, a commodity that is in increasingly short supply. This erosion of trust is evident in the global shift away from the dollar. Nations are diversifying their reserves, with central banks accumulating record amounts of gold. Why? Because gold is not just a hedge, it's a statement of sovereignty. Unlike fiat currencies, gold is no one's liability. It cannot be printed, sanctioned, or manipulated in the same way. Silver, too, plays a vital role in this narrative. Often overshadowed by gold, silver is both a monetary and industrial metal. Its applications in technology, renewable energy, and medicine make it indispensable in a modern economy. Yet its price remains undervalued relative to its historical performance and industrial demand. Rick Rule's observations about the silver market are particularly insightful. He highlights the cyclical nature of silver, noting that it often lags behind gold, but moves more dramatically when it does. This volatility, coupled with the current lack of sellers in the market, creates an environment ripe for significant gains. Rule recounts a recent trade where high-quality silver juniors saw their prices triple within 9 months, demonstrating the explosive potential of this metal. Investors often make the mistake of focusing solely on short-term price movements, losing sight of the bigger picture. As Rule aptly puts it, when you go into a silver bull market, you won't be concerned about dollar moves or $1.50. The real opportunity lies in understanding the long-term trajectory of precious metals, driven by structural shifts in the global economy. The transition from gold to silver leadership in a bull market is another key point. Historically, silver has outperformed gold during periods of heightened demand, driven by its lower unit price and broader industrial applications. This was evident in the 1970s and again in the 2000s, when silver saw dramatic price increases that dwarfed gold's gains. Rule also emphasizes the psychological resilience required to navigate the precious metals market. He recounts how many investors were shaken out during the mid-1970s, missing out on the monumental rally that followed. The lesson here is clear: patience and conviction are critical. Short-term volatility should not deter investors from holding on to assets that offer unparalleled long-term value. Another aspect worth noting is the disconnect between perception and reality in the gold market. Critics often dismiss gold as a relic, citing its lack of yield or immediate utility. However, these arguments miss the point. Gold's true value lies in its ability to preserve purchasing power over time. It is not an income-generating asset. It is an insurance policy against systemic risk. The growing interest in gold and silver among individual and institutional investors alike underscores this point. As trust in traditional financial systems erodes, people are turning to tangible assets that offer security and stability. This trend is not limited to the West. It is a global phenomenon, with emerging markets leading the charge.
Well, in dealing with the debt is politically unfeasible. Now, we dealt with it as a people before, although the problem was less severe. In the decade of the 1970s, politically we couldn't raise taxes, but we had to pay for deficits, and we had to account for the debt brought up in the war in Vietnam, which of course we lost, and the war on poverty, which of course we lost. How did we do that? Well, in the decade of the 70s, according to the U.S. government, through inflation, we reduced the purchasing power of the U.S. dollar by 75% over 10 years. Not coincidentally, the gold price went from $35 to $850. The only way that we can service the nominal debt that we have as a people, particularly our entitlements obligation, is to inflate away the net present value of the obligation while leaving the nominal value intact. An old geezer named Rick Rule, 71 years old. I don't know what Social Security pays me, but let's say it's $4,000. You know, I was a high-income taxpayer. 10 years from now, they'll still pay me that nominal amount. They won't reduce it, although they can't afford to pay it. What they will do is they will inflate away the net present value of that nominal account. So my $4,000 will buy me $600 or $700, maybe $1,000 worth of goods and services. That's how you deal with that sort of thing. You either default honestly, you say to the bondholders and you say to the entitlement holders, too bad, so sad, money's all gone, strong letter to follow, or you default gradually by inflating away the net present value of the purchasing power. My suspicion is past is prologue, and we take door B, which is very good for gold. Gold in 2024, who knows? Gold in 2025, who knows? Look over 10 years. If you look back to the decade of the 70s, it'll tell you something about the trajectory. 1970 to 1972, gold went from being controlled to decontrolled, so it was $35 to $100. Gold went on a tear from $100 to $200, doubled. 1975, the Fed raised the interest rates. Gold fell from 200 to 100. End of 1975, the Fed lost their nerve politically, cut the interest rate. And that set off a romp at the end of 1975 that saw gold go to $850. Past in this case is prologue. Gold will go up and down, higher bottoms, higher tops. People who don't understand the process will be shaken out when gold softens up. By the way, price decline from $2,700 to $2,600. It's a rounding error. It's truly a rounding error. 1975, the gold price fell from $200 to $100. That's a fall. People who got shaken out in 1975 missed a 5-year run from a $100 bottom to an $850 top. Folks need to give their head a shake. So I'm really attracted to negative social media discussions of any one topic. The lady or the gentleman who posted yawned, saying that gold or silver never performs. I read comments all the time that says, when is gold going to move? To which my answer is, let me think. I think gold's going to move in the year 2000. Since 2000, gold has moved from $253 an ounce to a high of 27 something, currently around 26. What is that, a 7-fold return? Gold has done 8 and change compounded annually for 24 years, and some moron says, when is gold going to move? It always fails. That person is innumerate. Mercifully for me, people who are probably smarter than me that don't apply their brains to the task at hand lose money while I make money.
The outlook for gold and silver in the coming years, particularly as we approach 2025, hinges on several compelling factors that extend beyond mere speculation. The underlying dynamics of global economics, shifting monetary policies, and the ever-looming specter of inflation all serve as catalysts for these precious metals to secure their place as enduring stores of value. One of the most striking arguments for gold and silver stems from their historical resilience during economic turbulence. As Rick Rule emphasizes, gold's track record over the past 50 years provides ample evidence of its ability to not only preserve purchasing power, but also deliver substantial returns in times of crisis. The 1970s, marked by rampant inflation and geopolitical instability, saw gold rise from $35 to $850 per ounce. This dramatic surge was not a fluke. It was a reflection of gold's intrinsic value as a hedge against the systemic failures of fiat currencies. Fast forward to today, and the global economic landscape mirrors many of the conditions that drove gold and silver to unprecedented highs in the past. Inflation, often underreported in official statistics, continues to erode the purchasing power of currencies worldwide. Central banks, grappling with mounting debt and political constraints, are resorting to inflation as a covert means of reducing the real value of their liabilities. This practice, while politically expedient, disproportionately benefits hard assets like gold and silver, making them indispensable in a well-diversified portfolio. Rick Rule's insights into investor psychology are particularly pertinent in this context. Many market participants are swayed by short-term price fluctuations, losing sight of the long-term narrative. The recent dip in gold prices, from $2,700 to $2,600, serves as a case in point. Rule aptly describes such movements as rounding errors in the grand scheme of a bull market. Drawing parallels to the 1970s, he reminds us that gold temporarily halved in value before embarking on a meteoric rise. Investors who lack the conviction to hold on during those challenging times missed out on one of the most significant wealth generation opportunities in history. Silver, often referred to as gold's more volatile cousin, has its own unique appeal. While it shares gold's monetary characteristics, it also boasts a strong industrial component, making it an essential metal in the transition to a greener economy. The rising demand for solar panels, electric vehicles, and other green technologies underscores silver's dual role as both a monetary and industrial metal. This duality positions silver for explosive growth, particularly as the global energy transition accelerates. Looking ahead to 2025, the price predictions for gold and silver are not merely optimistic. They are grounded in a solid understanding of supply and demand dynamics. Analysts and industry insiders suggest that gold could surpass $3,500 an ounce, driven by escalating geopolitical tensions, inflationary pressures, and central bank purchases. Silver, often described as gold on steroids, could see even more dramatic gains, with some forecasts placing it above $50 an ounce. These projections are not baseless. They reflect the convergence of multiple trends that are reshaping the global financial landscape. The role of central banks in this narrative cannot be overstated. Over the past decade, central banks have shifted from being net sellers of gold to net buyers, a trend that has accelerated in recent years. This strategic accumulation is not a coincidence. It is a calculated move to diversify reserves and reduce dependence on the US dollar. Countries like China, Russia, and India are at the forefront of this trend, using gold as a hedge against the vulnerabilities of fiat currencies. The ongoing de-dollarization movement adds another layer of complexity. The rise of alternative payment systems, such as those being developed by the BRICS nations, signals a growing discontent with the current dollar-centric financial system. These initiatives, often backed by gold, aim to create a more equitable and stable global monetary framework. For investors, this represents both a challenge and an opportunity. The shift away from the dollar could lead to increased demand for gold and silver, driving their prices even higher. Rick Rule's emphasis on liquidity and timing offers valuable lessons for investors navigating this complex landscape. While he advocates for a significant allocation to gold and silver, he also stresses the importance of maintaining liquidity in US dollars. This balanced approach allows investors to capitalize on short-term market opportunities while staying true to their long-term goals. Rule's own strategy, saving in gold, maintaining liquidity in dollars, and investing in undervalued companies, serves as a roadmap for managing risk and maximizing returns. Sentiment, as Rule points out, is a critical factor that often goes overlooked. Negative social media chatter about gold and silver, for instance, can be a contrarian indicator signaling a buying opportunity. This aligns with the broader principle that markets are as much about psychology as they are about fundamentals. When fear and pessimism dominate the narrative, astute investors see opportunity. The potential for outsized gains in junior mining companies adds another layer of intrigue to the gold and silver story. These companies, often undervalued and overlooked during periods of market pessimism, can deliver exponential returns as sentiment shifts. Rule's recent experience with a silver junior trade, where prices tripled within 9 months, underscores the potential of this high-risk, high-reward segment of the market. However, investing in junior miners requires a meticulous approach. Not all companies are created equal, and due diligence is paramount. Investors must focus on those with strong management teams, robust projects, and the ability to weather market downturns. For those willing to put in the effort, the rewards can be substantial. As we approach 2025, the case for gold and silver becomes increasingly compelling. These metals are not just safe havens. They are strategic assets in a world fraught with economic and geopolitical challenges. Whether it's protecting against inflation, diversifying a portfolio, or capitalizing on market inefficiencies, gold and silver offer a unique combination of stability and growth. In the grand narrative of wealth preservation and generation, gold and silver stand as enduring symbols of resilience and foresight. They are not merely commodities. They are testaments to the timeless principles of value and trust. For those who recognize this, the opportunities are not just promising, they are transformative. As Rick Rule eloquently puts it, the real question is not when gold and silver will move, but whether you are prepared to move with them when they do. For viewers and readers alike, the takeaway is clear. The time to act is now. The window of opportunity may be narrow, but the rewards for those who seize it are boundless. In a world of uncertainty, gold and silver offer not just a hedge against risk, but a pathway to enduring prosperity. As we venture into the future, these metals are poised to redefine the contours of wealth, stability, and security.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.